A very good morning to all of you students. Today we will continue with the topic of mergers and acquisitions. So in the previous session we did the concepts and up to question number 5 in the assignment. So let's start with question number 6 today. ABC, a large business house, is planning to sell its wholly owned subsidiary KLM. Another large business entity XYZ has expressed its interest in making a bid for KLM. So what they're saying is there is a ABC company which is already is a very large business house is having KLM, a subsidiary. Okay, and here the other one we have XYZ, which is an outside company, and it is planning to take a bid for the purchase of KLM. Okay, so it's interested for purchasing the KLM company. XYZ, that means the buying company, the company which is going to buy, expects that after acquisition, the annual earnings of KLM will increase by 10%. Okay. So they are saying because of acquisition, it is expected that the earnings, whatever KLM doing as of now, will increase by 10%. And we discussed also, right, in our previous sessions that why there will be an increase in the earnings always because of the synergy benefits, because of some of the cost cuttings, because of some of the economies of scale being operating, right? Following information, ignoring any potential synergistic benefits arising out of the possible acquisitions are available. So they are saying that these are the following assumptions, but ignoring any synergistic benefits because they have already given to you above, right? Which is this 10%. Profit after tax for KLM for the financial year, which has just ended, is estimated to be rupees 10 crore. So they're saying that the recent profit figure is around 10 crore. KLM's after tax profit has an increasing trend of 7% each year, and the same is expected to continue. Estimated post tax market return is 10% and the risk free rate is 4%. These rates are expected to continue. So they have given us that post tax market rate is this much, risk free rate is this much, and they're saying that the KLM's profit after tax has an increasing trend of 7% each year. So that means it is accumulating, it is increasing at the rate of 7% per annum. Corporate tax rate is 30%, which is fine. Now they have given you these additional informations as well. Number of shares. Now see, they have given it for XYZ, which is the acquiring company, ABC, which is selling its subsidiary, and proxy entity for KLM in the same line of business. By proxy entity, we mean the data pertains not for KLM but for an entity very similar to KLM, right? So, so proxy means, so basically it's a representative of KLM in the same line of business. Okay. Current share price is this much. Dividend payout, debt equity, price earnings ratio, and equity beta is what they have given. Assume gearing level. Now, students, here I want all of you to please take a note. Gearing level of KLM to be the same as for ABC and a debt beta of 0. Now, can anyone tell me what is gearing level? What do we mean by gearing level? Or what is your understanding on gearing level? Yes, Ojajani has replied debt equity ratio. So basically gearing level means that the amount of debt in the capital structure of a company, right? Because having a debt or not having a debt will have its own advantages and disadvantages as far as the capital structure of the company is concerned, right? So they are saying that assuming gearing level to be the same, that means the amount of debt available in a company's capital structure, assume it to be the same, which is the debt equity ratio, right? As for the ABC and a debt beta of 0. So KLM should be equal to ABC's debt equity ratio. You're required to calculate appropriate cost of equity for KLM based on the data available for the proxy entity. So they're asking us to calculate the appropriate cost of equity. Now, now we have a issue in hand that we have to calculate the cost of equity for KLM. So cost of equity for KLM is the cost of equity that we can calculate using what? Using CAPM, right? Using other methods we can calculate. But we have been given equity beta, right? But this equity beta is not given for KLM. Okay, it's given for proxy entity of KLM. So first we have to find out the equity beta of KLM itself and then arrive at the cost of equity, because risk-free rate of return 4% and market return 10% is already given. So we can make use of this along with the beta of KLM to arrive at the cost of equity for KLM. Now to do that, okay, there is a concept called ungeared beta. So ungeared beta is given by beta of equity multiplied by the equity value divided by equity plus debt 1 minus tax plus beta of debt multiplied by debt value 1 minus tax rate divided by equity plus debt 1 minus tax. So simply speaking, this is a weighted average beta, right, of debt and equity. So beta ungeared is a weighted average beta of debt and equity. This beta of equity is actually called as the geared beta. If you multiply the weights in that and add the debt beta, you arrive at the ungeared beta. Clear? So we will make use of this formula and arrive at the proxy company's ungeared beta and then arrive at the KLM company's geared beta. Okay? So beta ungeared is equal to, now proxy company's beta of equity is what? 1.1 multiplied by equity, which is, now we have to take the proxy company's debt equity 1 is to 4, right? So for equity component is what? 4. Debt component is 1. So 4 divided by 4 plus 1, 1 minus tax rate, right? Tax rate is how much? 30%. Plus debt beta is 0. Clear? Because see, one is debt beta is not given in the question. Second, they are also saying it as the debt beta is equal to 0 for KLM, right? Hence, for the proxy company also, we have assumed debt beta to be 0. Okay, so then beta ungeared becomes 0.9362. This is for the proxy company. Clear? So for the proxy company, the ungeared beta is 0.9362. Now, geared beta for KLM, we have to find out the cost of equity for KLM, right? For KLM needs to be ascertained for calculating KLM cost of equity. And we also know that cost of equity is equal to risk-free rate of return plus beta of equity or geared beta multiplied by RM minus RF, right? Market return minus risk-free rate of return. This is given as per the CAPM model, right? Capital asset pricing model, right? Students, are you there with me till now? Is there any other doubt? And now we have to calculate the geared beta, right?
Excuse me, sir.
Yes.
Can you please show again the beta ungeared amount? Is
Yes.
my calculation is not coming this, sir.
Then just a second. Let me again recalculate. Yeah. According to me, this is the number coming 0.93617, which I mentioned.
Now it is coming, sir.
1962. It's coming, right?
Yes, sir. Now it is coming.
Yeah.
Thank you, sir.
Yeah. Then let's move with the calculation of KLM's geared beta. So beta ungeared is equal to beta geared. Again, we are just putting the formula multiplied by equity divided by equity plus debt 1 minus tax rate plus 0. Right? Then beta ungeared 0.9362 is what we have calculated above for the proxy company. Beta geared is what we have to find out here, multiplied by equity and debt ratio. Now equity and debt ratio, it is mentioned for KLM, you assume it to be the same of ABC, right? So we will take 1 is to 3 here, this one. Okay, so this will be 3 divided by 3 plus 1, 1 minus 30% plus 0 again, right? Because debt beta is 0. Now if we solve this, the beta of equity is equal to 1.1546. This is for the geared beta, right? So cost of equity, hence it will become 4% plus 1.1546 multiplied by 10% minus 4%. Sorry, 10.93%. So this is the cost of equity for KLM. Yes, Ojajini, your answer is correct. So the first part of the question was to calculate the cost of equity for KLM. Hence the cost of equity for KLM is 10.93 percentage, students. Clear? Then the second point is a range of values for KLM both before and after any potential synergistic benefits to XYZ of the acquisition. So they are saying that whatever will be the range of values for pre and post, that we have to find it out. Now, given the data that we have, we can how we can calculate the value, because here we just need to tell them the values, right, for the for purchasing the KLM. Now, one is we can make use of PE ratio that is available, right? And second is we also have been given dividend payout. So can we make use of the dividend model for the valuation? The answer is yes. So using both the techniques, we can find out the ranges, and one, we will definitely use the KLM proxy data that we have been given, right? And the second one, we will use the XYZ data, because XYZ is the purchasing company. It will try to calculate all the numbers basis its own estimates, right? So let's do that. Let me write it over here. Second part is actually valuation based on earnings, right? So using proxy, and here it will be using XYZ. Okay. Here we will have pre-synergistic value, wherein we will say 12 is the PE multiple, right? For proxy, what is the PE multiple? 12. Here it is. Okay. And what is the earnings? Earnings is 10 crore. Pre-synergies again. Okay. And then for XYZ, 10 is the PE and 10 are the earnings. So here it will become 120 crores and here it will become 100 crores, right? Then post synergistic value, it will be 12 times the multiple, 10 crore the profit, and 10% is the synergy, right? So into 1.10, this will become 132 crore, and here 10 times multiple, 10 crore profit, and 1.1 times the 1.1 times the synergy benefit, right? So it will become 110 crores. So this is basis the method of PE valuation. I mentioned here A part as PE valuation. Second, let's calculate using dividend model. So we will be making use of this formula, D1 divided by KE minus growth is the value of business. Remember, right? So please remember, students, here it is D1, not D0. D1 means whatever is expected to be earned after 1 year. Whatever is expected to be paid as dividend after 1 year, right? So let's put it. This is for proxy, and again this is for XYZ. Pre-synergistic value 10 crore multiplied by 0.50 multiplied by 1.07 divided by, so the 0.50 is the dividend payout ratio for proxy company, right? 10.93% was the cost of equity that we calculated, and 7% is the growth rate, correct? And for XYZ, again, 10 crore, what is the dividend payout ratio of XYZ? 0.40 multiplied by 1.07 to make it D1. That's why we are multiplying it by this, and 10.93 minus 7% to arrive at the numbers. Here it will become 136.13 crores. Here it will become 108.91 CR. Then post synergistic value, simple, we will just have to multiply with 1.1 as well. So in this case, it will become 10 crore is the earning into 1.10 for synergy. Zero point 0.5 will be paid as dividend, and 1.07 is for making it to after 1 year, right? Future value. So 10.93 percentage minus 7 percentage. This becomes 149.75 crores. And using XYZ, we will have 10 crores into 0.40 is the dividend payout ratio. 7% into 1.10 divided by 10.93% minus 7%, 119.79 crores. Clear, students? So these are the post synergistic values. So these are by using the two different data sets. One is for the XYZ company, which is the acquiring company, and second one is for the proxy company. Clear? Now we can also put down the range here. What is the minimum and maximum range? That also we can put it down. So minimum, this is pre synergistic, is 100 crore, right? Between both the methods, if you see, it will come as 100 crore, and the maximum is coming as 136.13, and post synergistic 110 crores and 149.75 crores. Clear? So this was it from question number 6, students. Is there any other issue? Please do let me know. Clear, yeah. So let's move to question number 7, students. Okay. Question number 7 says that given is the following information: net earnings 5 crores and 3.5 crores, number of equity shares. The shares of Day Limited and Night Limited trade at 20 and 15 times their respective PE ratios, right? So Day Limited considers taking over Night Limited by paying 55 crores, considering the market price of Night Limited reflects its true value. So they have fixed the consideration as 55 crores. It is considering both the following options: takeover is funded entirely in cash, takeover is funded entirely in stock. You are required to calculate the cost of the takeover and advise Day Limited on the best alternative. Simple, so we have to evaluate from both the angles. So let's start, students. Solution. Let's first find out that what is the real value of the Night Limited, right? For that, we have been given the PE ratio. That's the simplest thing that we can do. We have to just multiply the earnings with the PE multiple. So net earnings, here it is 5 crores and here it is 3.5 crores, right? And number of equity shares, here it is 10 lakh, there it is 7 lakhs. PE ratio is 20 times, here it is 15 times, right? Then EPS, if we calculate it, it is 5 crore divided by 10 lakhs, which is 50. 3.5 crore divided by 7 lakh, which is again 50. Market price per share, yes, 52 both. Market price per share is 20 into 50, which is 1000. Here it is 50 into 15, which is 750. And hence the market capitalization. The market capitalization is 100 crore and 52.5 crore. So market capitalization is MPS multiplied by number of equity shares, right? So here it becomes 100 crore, here it becomes 52.50 crores. Okay, students. Now if takeover is funded by cash, so 52.5 is the takeover value and 55 crore is what we are ending up paying. So that means from day limited perspective, it's not a good deal, right? It's not a good deal because you are ending up paying more. So cost of takeover to day limited will become 55 crore minus, okay, which effectively means that 2.5 crores is the issue, right? So that means 2.5 crore we are paying extra if we are supposed to pay in cash. Now let's talk about the B part. If takeover is funded by stock, now in such a case, first we have to calculate the number of shares to be issued. It is around 55 crores divided by 1000 is the price per share, right? So that means 5.5 lakh shares needs to be issued. And the combined market value will become how much? 100 crore plus 52.50 crore, which is their respective market values. It becomes 152.50 crores. And again, this is for day limited. This is for night limited. Right? So both the values put together is 152.50. Now proportion of night limited in this will be how much? Proportion of night limiteds shareholder in the shareholders in the delimited's revised capital structure will be 5.5 lakhs divided by 10 lakhs plus 5.5 lakhs, right? So 35.48 percentage becomes the proportion of Night Limited's shares in the revised capital structure, right? Now, if we ask the true cost of merger here again, then this will be given by 152.50 into 0.3548 minus 55 crores, right? So this is minus 0.893 crores. So if you see, students, this is coming out to be in minus, which effectively means that the takeover is positive from the side of purchasing company, because the purchasing company is able to pay less to acquire more. So definitely the company will go ahead with the takeover by stock. Since the true cost is negative in case of funding from stock, Day Limited would be better off by funding the takeover by stock. Easy and simple, students. Clear? Any doubts, students? Let me check the queries. No, there is nothing as of now. Perfect. Okay, let's move ahead then to question number 8. Okay. See, again, I would say that there is none of the question is very similar, right? They don't follow any specific pattern. It can be that you are in the middle of some specific issue, and you will have to apply whatever is given in the question for those and accordingly let the answer. Okay. Now, question number 8 says Hanky Limited and Shanky Limited operate in the same field, manufacturing newly born babies' clothes. Although Shanky Limited also has interest in communication equipments, Hanky Limited is planning to take over Shanky Limited, and the shareholders of Shanky Limited do not regard it as a hostile bid. That means they don't regard it as a disadvantageous thing. They say that okay, we can evaluate it. The following information is available about the two companies, Hanky and Shanky. Current earnings, they have given number of shares, percentage of retained earnings. If the percentage of retained earnings is given, that means balance is the dividend payout. Return on new investment is also given, return required by equity shareholders. So this is cost of equity, return required by equity shareholders, and this is R, which is rate of return, right? Return on new investment. Dividends have just been paid and the retained earnings have already been reinvested into the new projects. So whatever is the 20% or 80%, they have actually reinvested. Hanky Limited plans to adopt a policy of retaining 35% of the earnings after takeover and expects to achieve a 17% on the new investment. So they are saying once Hanky Limited acquires Shanky Limited, so they will maintain a retained earning ratio of 35%, and similarly our revised one they have given. Savings due to economies of scale are expected to be 85 lakhs per annum. This is nothing but the synergy benefits, right? As we mentioned that these synergy benefits can be due to a number of reasons. Here it is in case of economies of scale. Required return to equity shareholders will fall to 20% due to the portfolio effects. The revised cost of equity will become 20%. Requirements: calculate the existing share prices of Hanky and Shanky Limited. It's a very simple question, right? So it is saying that you have to calculate the existing share prices, right? So we'll take Hanky Limited, we'll take Shanky Limited. So here we know that growth is equal to B into R, right? R is the rate of return and B is the retained earnings. Whatever you retain and whatever you earn on that retained amount becomes your growth, right? Because growth is delta. So 0.15 into 0.2 is actually 3%, right? So for Henke Limited, the 20% is the retention amount and 15% is the return on new investments. Similarly, zero point 0.8 and 0.15, this becomes 12%. And market price per share is equal to D1 divided by KE minus growth rate. Again, the same formula, dividend growth model. So in MPS, this will be given by 6.5 crore is the earnings. On that, we are paying a dividend of 80%. So if 20% is what we are retaining, balance 80% is what we are paying. And 3% is the growth rate, right? This one. Similarly, cost of equity is what currently 21%, right? So 21% minus 3%, the growth rate. And similarly, for Shanky Limited, the MPS will be calculated as 2.4 crore, which is the current earnings multiplied by 20%, which is the dividend payout ratio. 1.12 is the growth rate, 12% is the growth rate, right? Cost of equity was how much? 24. So 24 minus 12 percentage. Clear, students? So the above one will give us as, again, this will give us the overall value, right? This is not MPS. This will be giving us the overall value, which is how much? 29, 75, 55, 556 divided by 50 lakhs is the number of shares. And hence it will give us 59.51 per share. Similarly, here it will be 44 8 lakhs divided by number of shares is how much? 15 lakhs, and hence it will become 29.87 per share. So these are the market price per share, MPS. Okay, students. So the first part is solved for, which was the easier one. Find the value of Henke Limited after takeover. Now they are saying Henke Limited after takeover. Simple. We will calculate the revised earnings. We will apply the revised numbers in terms of growth, in terms of return, cost of equity, and arrive at the numbers, right? So now the revised growth will become, so 17% is the return on investment for the combined entity, right? And 35% is what they're going to retain. So this will be 6% at the overall level in terms of growth. Cost of equity revised becomes 20%, and the next year earnings will be 6.5 crore for Hanky plus 3.5 crore for Shanky, sorry, 2.4 crore for Shanky, plus 0.85 crore for the synergy, because 85 lakhs is what it is given, and we will multiply it with a growth rate of 6%. Clear? So the next year earnings will become 10 crore 23 lakh 30,000, right? And hence the next year dividend will be 65% of this amount, 23 lakh 30,000, because 35% is what we are retaining. So balance 65% is what we will pay. It becomes 6 crore 71 lakh 77,500, and hence the market value is actually 671,77,500 divided by 20% is the cost of equity minus 6% is the growth, right? KE minus G. So the market value, it becomes 4 10.335 is what? Sorry. So 4,798,39,286. Okay, so this is what the market value is coming. This is, I think, the second part, because it is seeing the value after the takeover. Advise Hanky Limited on the maximum amount it should pay for Shanky Limited. Simple. This is the total combined value minus whatever was the pre-merger value of Hanky Limited. The difference is what Hanky Limited should be able to maximum pay to Shanky Limited, right? Combined value 479839 286 less present value of Hanky Limited, right? Which is the current company, right? Which is the acquiring company, that is 29 75 55 556, right? So it will become 18 crore, no, sorry, 1822 crore. Sorry, 18 crore 22 lakh 83,730. Okay. This is the maximum amount that can be paid for Shanky Limited. Will be this much. Clear, students? This was again a very easy question. Just we have to calculate simply the values first, and then arrive at the combined value, and then arrive at what is the maximum amount that can be paid from Hanky Limited's side, right? Because Hanky Limited will deduct its own value from the overall value. So whatever is the net addition, that Hanky Limited will be able to drive it, right, in terms of the payment. Now let's come to question number 9, students. MPLC and CPLC operating in same industry are not experiencing any rapid growth but providing a steady stream of earnings. MPLC's management is interested in acquisition of CPLC due to its excess plant capacity. Share of CPLC is trading in the market at pound 4 each. Other data relating to CPLC is as follows. So they have given us the profit after tax, and see, they have given it for the combined entity also. Residual net cash flow per year is also they have given a required return on equity. Balance sheet of CPLC They have given us, so in assets they have current assets, other assets and property, plant and equipments. Liabilities, they have current liabilities, long-term liabilities, reserves and surplus, share capital, 5 million common shares at the rate of £1 each. So that makes it to 5 million pounds. You're required to compute the minimum price per share CPLC should accept from MPLC. So they are talking about what is the floor value that CPLC should quote for the MPLC for its takeover, right? So let's start. So first of all, value of CPLC is actually residual cash flows divided by KE minus growth rate. So which is actually 40 lakhs, right? Residual cash flows for CPLC is how much? In this one, 4 million or 40 lakhs, whatever we want to say, divided by 11.25%. Again, the required return on equity minus growth is not given, so we will assume it to be the zero, right? So it gives us bond of 35 triple five 556, right? This is the value. Now MPS will be market price per share, right? This will be 35 555 556 divided by 5 million, which is 7.11 pounds, right? This is the market value. This is the market price appearing. Then similarly, can we also compute the book value because we have been given the balance sheet? Yes. So 29,750 is their book value, right? Which is effectively, if you see share reserves and surplus plus share capital, right? Divided by 5 million is the number of shares, 5.95 per share. This becomes clear. So we have calculated the book value of CPLC, market price of CPLC, right? Now value of MPLC is actually, we will arrive at it by again taking the earnings, the residual net cash flow divided by the required rate of return of 12.5%. 6 million divided by 12.5% minus 0, 48 million. And hence the value of combined entity, which is as per the data given in the next column, students. This is how much? 12 million, right? So 12 million divided by 12%. So that is around 100 million, right? So 100 million is the total combined value. MPLC separately we have been given and CPLC separately we have been given. Can we calculate the value of synergy? Yes. Value of synergy will be calculated as whatever is the combined value. I mean combined entities value. From this we will reduce the individual values taken together. CPLC plus value of MPLC, right? So this will be minus 48 plus 35 triple five 556, right? Individual values taken together minus from the overall combined entities value, right? So this will become 16 triple four triple four. Okay, so these are the calculations that we have done, students. Now first part, we'll have to calculate the minimum price per share CPLC should accept from MPLC, which is definitely the at least the book value, right? Minimum to minimum, they should expect the book value. So the first part is, let me write it over here. Minimum price per share. So which is CPLC should recover from MPLC is 5.95 pounds, which is the current book value. Then second is maximum price per share MPLC shall be willing to offer to CPLC. So it has to be computed, right? It has not yet been directly taken. So let's compute that. Shall be willing to offer to CPLC shall be computed as follows. So what it will be? Value of CPLC as well as the synergy benefits, right? See, because ultimately I will be able to give it, let's say okay, there are two ways to see it. One is the total value of the combined entity, which is 100 million minus the MPLC's market value, whatever is that left value that MPLC should be willing to give it to CPLC. That is the maximum amount, right? And the second way to look at is CPLC values plus synergy benefits, which is again one and the same thing, right? Value of CPLC plus synergy benefits divided by number of shares of CPLC. 35 triple five 556 plus 16 triple four, right? That was the synergy benefits. And because you have to find out the per share value, so we will divide it by the number of shares of CPLC, right? 10.40 students, right? So this is the maximum amount which MPLC can give it to the CPLC shareholders. Clear, students? Yeah. Then next one, the third part, floor value of per share CPLC, whether it shall play any role in decision for its acquisition by MPLC. Just a second. So if we see share of CPLC is trading in the market at pound 4 per share, right? So can we say that this is the, and okay, now if we compare this, basis the market price value should be 7.11, basis the book value is 5.95, and basis the market price, the actual market price which is operating in the market is 4. So do you feel that CPLC while getting into the negotiation, it will take ahead which value? Definitely not 4, right? So in a way, what the question is trying to ask us is that whatever is the minimum to minimum value that CPLC should be willing to accept, whether it will have any role to play. The answer is no, right? Because it's still lesser than the current book value, right? So if we see this, see first of all, what is the floor value? The floor value is the minimum value out of all these three, which is the current market price, right? Floor value per share of CPLC shall be 4, which is current market price, and it shall not play any role in decision making for the acquisition of CPLC, as it is lower than its current book value. Clear, students? Let's move to question number 10. X Limited is interested to acquire PB Limited. X Limited has 50 lakh shares of rupees 10 each, which are presently being quoted at 25. On the other hand, PB has 20 lakh shares of rupees 10 each, currently selling at rupees 17. X and PV have a EPS of this and this respectively. That means we can calculate the PE ratio because we have the EPS and we have the market price also. You are required to show the impact of merger on EPS in case if exchange ratio is based on the relative proportion of EPS. Sorry. So they have given you that if the merger happens and the exchange ratio is basis the EPS, then what is the impact on EPS? Suppose if X Limited quotes an offer of share exchange ratio of 1 is to 1, then should PB should accept the offer or not, assuming that there will be no change in the PE ratio of X Limited after the merger. So using this exchange ratio, whether it is acceptable to the target company or not, simple. The maximum ratio likely to be acceptable to the management of X Limited. That means the acquiring company should be willing to pay maximum to maximum what swap ratio. So let's first calculate the swap ratio basis EPS. Students, you would recall in our previous session we discussed about the different ways to calculate a swap ratio. One of them was EPS, right? So here we will take EPS of PB Limited, which is the target company, and we will take EPS of X Limited. So this will be 2.4 divided by 3.2. Correct? So this becomes 0.75 is to 1. So 0.75 share of X Limited will be issued for a single share of PB Limited. Okay. Then earnings for X Limited is actually how much? 3.2 is the EPS. Number of shares is 50 lakhs. So this will give us 1 crore 60 lakhs. Right? Then earnings for PB Limited will be 2.40 into 20 lakhs. This is 48 lakhs. Right? So the total earnings becomes 2 crore 8 lakhs. Total number of shares to be issued will become 0.75 is the exchange ratio, right? On 20 lakh shares. Correct, students? 20 lakhs is the total shares issued by PB Limited. On that 0.75 shares will be multiplied to arrive at 15 lakh. So 15 lakh shares of X Limited will be issued to the 20 lakhs worth of shareholders of PB Limited. Clear? And what is the existing shares of X Limited? 50 lakhs, right? Existing number of shares of, sorry, X Limited is actually 50 lakhs. So in totality, we have a number of 65 lakhs. Total shares of X Limited. Clear? Now, let's see what is the EPS post merger, because that is what we have to analyze, right? EPS post merger and pre merger. So, EPS post merger is equal to 123, right, divided by 65 lakhs. So, this will become 3.20 per share. Yeah. So, the revised EPS becomes 3.2 per share. So, if we calculate the impact for X Limited and PB Limited, then EPS before merger is 3.2, 2.4, right? And EPS after merger is also 3.2, right? And here, as I said that for the B limited, you remember in all our formulas in the previous session, we said for B limited, if any ratio of post merger has to be calculated, it has to be always multiplied with the swap ratio. So 3.2 multiplied by 0.75 will be the correct number, which is the like to like comparison of one share pre-merger of PB Limited and one share post-merger of PB Limited. So this also becomes 2.4. So this is same again. See, logic is very simple. We have used EPS for calculating the swap ratio. And while for calculating the impact also we are doing it on EPS. So it can never be different, right? Because the swap ratio itself is calculated using the EPS, right? So post merger impact, there is nothing. Then the second part, suppose if X Limited quotes an offer of share of exchange of 1 is to 1. Now they are offering it a higher one. Then should PB accept the offer? Then let's do it like this. PB Limited should accept the offer, right? Accept the offer. Can anyone tell me why? Why are we saying it should accept the offer? The answer is simple, right? As 1 is to 1 swap ratio is higher than 0.75 is to 1. Yes, correct. And PB Limited would be in a better situation. Then third part, maximum ratio likely to be acceptable to the management of X Limited. Whatever is the maximum ratio that we have to compute. Now that we have to compute, right? That we cannot put it easily. So the maximum ratio acceptable to X Limited. What is that? The total market value combined is how much? 1625, right? How have we calculated the combined value multiplied by, so this EPS post merger, right? For that, the earnings that we have taken multiplied by PE ratio. PE ratio is calculated as price divided by earnings, right? So 25 divided by 3.2. That will give us the PE ratio. Correct, students? So this will become 1625 minus current market value of X Limited. Sorry, I think this is the third time in today's session that we are calculating this maximum ratio acceptable to the acquiring company, right? So in that, the process is very simple, right? The companies, they are taking out the total value, combined value entity minus they are reducing their own value and arriving at the differential amount. Current market value of X Limited, 25 into 50 lakhs, which is 1250 as a reduction, and hence the net amount becomes 375. So the number of shares is equal to 375 lakhs divided by 25, which is 15 lakh, 15 lakh. So number of shares is 375 is the maximum amount that we can pay. I can just mention here it is rupees in lakhs, right? And for now existing number of shares are how much? Is actually 20 lakhs, right? Clear, students? So this 25 is actually the market price that we have reduced divided by, okay, to arrive at the number of shares. And hence the exchange ratio will be 15 lakhs over 20 lakhs. 0.75 is to 1, students. So the maximum exchange ratio acceptable to the shareholders of X Limited is also 0.75 is to 1. So see, if you really understand this, even from the PB Limited, even from the X Limited, the single ratio acceptable is coming out to be 0.75 is to 1, right? Clear, students? Perfect. Now let's move ahead to question number 11. B Limited is a highly successful company and wishes to expand by acquiring other firms. It expect its expected high growth in earnings and dividend is reflected in the P/E ratio of 17. The board of directors of B Limited has been advised that if were to take over the firms with a lower P/E ratio than its own using a share for share exchange, then it could increase its reported earnings per share. C Limited has been suggested as a possible target for takeover, which has a PE ratio of 10. It has a lower PE ratio and 1 lakh shares in issue with a share price of 15. B Limited has 5 lakh shares in issue with a share price of 12. Right? So they are saying the target company has a higher share price of 15 rupees and they have a PE ratio of 10. Calculate the change in the earnings per share of B Limited if it acquires the whole of C Limited by issuing shares at its market price of rupees 12. Assume the price of the B Limited share remains constant. Okay, perfect. So let's move ahead. So, so the question is very simple. It has given us the B Limited's some numbers. It has given us C Limited's numbers, and moreover, it is saying B Limited's numbers will remain same. So let's plot them. B Limited and C Limited. PE ratio has been given. B Limited has a higher PE ratio. C Limited has a lower PE ratio. Number of shares is given as 5 lakhs over here and 1 lakh for C Limited. Now MPS, which is the market price per share, is 12 here and 15 here, and hence the earnings. Can we calculate the earnings? The answer is yes. Earnings becomes 5 lakh into the P. So 5 lakhs divided by the P ratio, basically, right? Multiplied by MPS, right? To arrive at the EPS. So 17 and 12 will give us the EPS, correct? So 5 lakh multiplied by EPS will give us the overall earnings. Similarly, 1 lakh into 15 is the MPS divided by 10 is the PE ratio, students. So in the first case, the earnings becomes 352 941. This is for B Limited. For C Limited, the earnings are 1,50,000. Clear? And hence the swap ratio basis the price, right? Will be price of C Limited divided by price of B Limited, which is actually 15 by 12. 1.25 is to 1. Definitely the price of C Limited is higher, right? As just now we saw, so that the exchange ratio will also be higher, right? So for every one share of C Limited, 1.25 shares of B Limited will be issued. So that total number of shares to be issued by B Limited, 1.25 multiplied by 1 lakh, right? Because 1 lakh is the total number of shares outstanding for C Limited. So 1,25,000 worth of shares will be issued by B Limited. Now, can we know that what is the total number of shares after issuing these shares from B Limited's books perspective? The answer is yes. So 5 lakhs were the existing one, 1.25 are the new issued ones. So 6,25,000 is the total number of shares. Number of shares outstanding for B Limited is actually 5 lakhs and 1,25,000. So the total becomes 6,25,000. And hence the EPS after merger, it becomes 352 941, right? Which is the earnings of which company? B Limited. And 1,50,000 for C Limited, whole divided by 6,25,000. So the EPS post merger, very good, Ochajini, 0.804. So EPS post merger becomes 0.80. What is the present EPS? For calculating present EPS, we have the earnings, which is 352 941. 352 941 divided by 5 lakhs is the number of shares, right? Existing number of shares is 5 lakhs. So we arrive at 0.71. Yeah. 0.7059 is also correct. I have just rounded it off and mentioned it as 0.71, student. Okay, then EPS for B Limited is increased from 0.71 to 0.80, right? After acquisition. EPS of B Limited is increased from 0.71 to 0.80 students. See, now let's see what was the question indicating. So as to finally conclude, calculate the change in the earnings per share. So that we have calculated if it acquires the whole of C Limited by issuing the shares at the market price of 12. See, the question indicated us that in this case we will have to calculate the swap ratio using the market prices, right? And in this case, using market prices, if we calculate the swap ratio, it is coming out to be higher because the target company's share price was higher. That's why. Clear, students? So, again, a very easy question. So, I think any doubt, students, till now, please do let me know. We have been practicing a lot of questions, and similarly, we have a lot of questions to cover ahead as well. 12, 13, 14, 15. Yeah. We have some of the really good and interesting questions coming ahead. 19th and then finally 20th. Yeah. We have a very good question on one of the bank merger also. Right? We will cover up some of the theoretical part and then we will end it up with the startup. Yeah. Perfect. So yeah, students, I'm asking, is there any other query which is to be answered, which you feel, please feel free to ask for the questions covered till now, for the concepts covered till now. I'm happy to take them up. Nothing. Okay, then let's break for 10 minutes, students. Uh, we can again come back at 8:33. Okay. The question number 12. Elron Limited plans to acquire Doom Limited. The relevant financial details of the two firms prior to the merger announcement are: market price per share they have given for Elron Limited and Doom Limited. Number of shares outstanding also they have given 20 lakhs and 10 lakhs. The merger is expected to generate gains which has a present value of rupees 200 lakhs. The exchange ratio is agreed between the exchange ratio is agreed to be 0.5. What is the true cost of the merger from the point of view of Elron Limited? Okay, because Elron Limited is going to acquire. So let's start, students. So the true cost of merger from the point of view of Elron Limited will be actually the gain from Dooms Limited point of view. Gain from Dooms Limited point of view, right? So the swap ratio is taken as 0.5 is to 1, right? So the shares to be issued to Dooms Limited will be how much? Currently they have 10 lakhs, right? So 10 lakhs into 0.5, 5 lakhs. So shares to be issued to Dooms Limited is equal to 0.50 into 10 lakhs, which is equal to 5 lakhs. Yeah. Then percentage of Doom Limited in overall capital structure will be how much? 5 out of 20 plus 5, right? 20 is the existing Elron Limited's shares, and another 5 is what to be issued to the Dooms Limited shareholders. So 5 out of 25, which is effectively 20%. So the value post merger is actually 50 into 20 lakhs. This is the value of Enron Limited. Then for Doom Limited, it was 10 lakhs number of shares into 25 is the market price. So 25 into 10 lakhs. This is the value of Doom Limited, and the synergy benefits is also given as 200 lakhs, right? So this is the combined value post merger, 1450 lakhs, right? Which has again two different components, 80% and 20%. So 20% is denoted by Doom, correct? Because of 5 by 25 ratio, and 80% is denoted by Elrond. Okay. So the true cost of merger into 20% minus 10 lakhs into 25, right? So true cost of merger will become 1450 is the overall value of the company post merger. In that we will multiply it with the 20% because 20% belongs to Doom Limited, right? So this value post acquisition belongs to Doom Limited. That is point number 1, minus the current value of Doom Limited, which is 10 lakhs into 25, will give us the true cost of merger. That means this is the real extra amount that we have paid to acquire Doom Limited. This is from the point of view of Elron Limited, because the gain of Doom Limited will become cost of Elron Limited. This is actually 40 lakhs. Yes, very good, Ujajini. So true cost will become 40 lakhs. Clear, students? Now let's go to question number 13. MK Limited is considering acquiring NN Limited. The following information is available. They have given us MK Limited and NL Limited, earnings after tax, number of equity shares, market value per share. Okay. Exchange of equity shares for acquisition is based on the current market value as shown above. So they're saying that the swap ratio is calculated using the current market value. There is no synergy advantage available. Find the earnings per share for company MK Limited after the merger. Simple. We have to first calculate the swap ratio, then we have to calculate the post merger EPS. Then, after calculating the post merger EPS, we will have to calculate the impact on the earnings per share. Simple. So, solution, calculation of swap ratio, first of all. So, basis market price per share, we will have to take market price of NN Limited divided by market price of MK Limited. Correct? NN divided by MK. So here it will become 160 divided by 200. Very good, Udajini. Your answer is correct. So this is 0.8 is to 1. Clear? So the number of shares to be issued is 0.8 on overall number of 3 lakhs, right? So 1 lakh, 2 lakh 40,000, sorry. Total shares post merger will become sorry. So 12 lakhs are the existing shares and 240 are the new issues, right? Yes, very good. It will become 14 lakh 40,000, right? So it will become 14 lakh 40,000. Now, if the total shares are 14 lakh 40,000, let's combine the earnings also. 60 lakhs plus 18 lakhs, right? EPS after merger will become the total of these two divided by the total number of shares. Yes, 78 lakhs. Very good, Ojajini. So EPS after merger, 78 lakh divided by 14 lakh 40,000. So this will become 5.42 per share. Yes, very good. Ujajini, your answers are correct. Okay, so this is the post merger EPS of MK Limited. Clear? Now we have to calculate exchange ratio so that the shareholders of NN Limited will not be at loss. So now they are saying from the perspective of NN Limited, you have to calculate the exchange ratio. So exchange ratio basis EPS. Why? Because in the previous question, I think in the last couple of in the last to last question we discussed, right? If the swap ratio was getting calculated basis EPS, the post merger EPS will also become the same because the basis for calculating the swap ratio is EPS itself. So in case the NN Limited company's shareholder should not suffer a loss in terms of the EPS, they should be taking at the EPS as the basis for calculating the swap ratio. So here we will calculate EPS of NN Limited divided by EPS of MK Limited. Okay, effectively, which is 18 lakh divided by 3 lakh, whole divided by 60 lakhs divided by 12 lakh is equal to, so this is 6, this is 5, right? So the number of shares to be issued by MK Limited is basis 6 by 5 ratio. By MK Limited. 6 by 5 into 3 lakhs. Yeah, student. So in this case, if you see, the exchange ratio is coming out to be higher, right? Because the earnings are more of NN Limited, but the market prices was lower, right? Compared to MK Limited. That is the reason. Yes, 3,60,000 shares. Right. So now EPS after merger is equal to 3,60,000 into 5. Sorry, my bad. We'll have to compute the total earnings, which is this 78 lakhs we have computed above. So 78 lakhs divided by 12 lakh plus 3 lakh 60,000, which is equal to 5. Clear? So 5 becomes the EPS after merger. Clear? And if you really ask, so EPS for NN Limited's shareholder post merger will be 5 multiplied by the swap ratio, right? So it will become 6 effectively. Correct? So 5 is the post merger EPS multiplied by the swap ratio 6 by 5, it will become 6. So ultimately, 6 was the pre merger EPS of NL Limited, 6 is the post merger EPS of NL Limited, and hence NL Limited will not be at any loss. Since post merger EPS of 6 attributable to NL Limited shareholders is similar to pre-merger EPS, the shareholders of NL Limited would not be at a loss if swap ratio is 6 by 5 is to 1. Clear? Now, if we see earnings available for equity shareholders of NL Limited is how much? 3,60,000 into 5, which is 18 lakh. Available for equity shareholders of NL Limited. It will be 3,60,000 into 5, which is equal to 18 lakh. MK Limited, NN Limited. And here it will be 6 by 5, which is effectively 1.2 is to 1. Right? So MK Limited will push for 0.8 is to 1 as the swap ratio. NL Limited will push for 6 by 5, which is 1.2 is to 1. So let's say somewhere they will agree to a common ratio of, let's say, 1 is to 1. Right? I'm just saying as a part of their negotiation. So they will start by this. Because see, the acquiring company would always want the lower swap ratio. The target company would always want a higher swap ratio because they're giving up the company. They're selling their company, right? Yes. Perfect. So this was it, I think, on question number 13. I think a very, again, simple and easy question. Let's go to question number 14. The CEO of a company thinks that shareholders always looks for EPS. Therefore, he considers the maximization of EPS as his company's objective. His company's current net profits are 80 lakhs and the PE multiple is 10.5. He wants to buy another firm which has current income of 15.75 lakhs and PE multiple of 10. So they have given the target companies as well as the acquiring companies income as well as the PE multiple. What is the maximum exchange ratio which the CEO should offer so that he could keep EPS at the current level, given that the current market price of both the acquirer and target company are 42 and 105 respectively. If the CEO borrows funds at 15% and buys out target company by paying cash, how much cash should he offer to maintain his EPS assuming tax rate of 30%? Clear, students? See, now they're saying that there are two options, right? One is to pay in cash. So what is the maximum cash that they should pay? Or second one is the what is the maximum shares that they should issue, right? Now, if you really ask, the maximum exchange ratio that the CEO should give is to be given in such a manner that the price should be the that the EPS should be at the current same level. Simple, right? If they want the EPS to be at the same level, basis that we will have to devise a maximum exchange ratio, right? So the name of the companies are not given. So let's do one thing: acquirer and target company. Okay. Now let's start with whatever has been given in the question. So P multiple is given 10.5 and 10. Net profits are also given 80 lakhs and 15.75 lakhs. 80 lakhs and 15.75 lakhs. MPS, market price per share, is also given 42 and 105. Can we calculate the EPS? Answer is yes, because we have to compute certain things basis EPS, right? So we need to know what is the EPS. EPS can be calculated by net profits divided by the, so 42 divided by the PE multiple. We will calculate the, or sorry, we can take the MPS of 42 and divided it by the P multiple to arrive at the EPS, because P multiple is also expressed as MPS divided by EPS, or it can also be expressed as total market cap divided by the total earnings, right? So EPS will become 42 divided by 10.5 is equal to 4, and here it will be 105 divided by 10, which is equal to 10.5. Clear, students? And hence the number of shares will be 20 lakhs over here and 1.5 lakhs over here. How we are saying that? Because 80 lakhs is the total net profit divided by EPS of 4 will give us 20 lakhs. And similarly, 15.75 lakhs divided by 10.5 as the EPS will give us 1.5 lakhs number of shares. So we have been able to calculate the number of shares. Now the condition precedent to issue the maximum number of shares is that the EPS should remain constant. Now if the EPS should remain constant and the number of shares needs to be computed, so let us assume the number of shares to be issued as X. so that conveniently we can put it in the equation and solve for x, right? Let the number of shares to be issued to target company bx, then EPS will be right, then EPS will be, so let's put this side of the equation. 80 lakhs is the earnings of acquiring company plus target company has a earning of 15.75 lakhs, whole divided by 20 plus x. 20 is the existing number of shares plus x is the number of shares to be issued to the target company. And the EPS before merger was 4, right? So let's equate it to 4. I hope the equation is clear, students. So the EPS pre-merger is equated to these amounts. So if we solve for this, the x becomes 393750 shares, and hence the exchange ratio will be this divided by the existing number of shares were how much? 1.5 lakhs, right? So it will be 2.625 per share of target company. How we have computed this? 393750 divided by 1,50,000. Clear, students? So this is the exchange ratio at which the EPS will remain same. Now we have to calculate the cash payout at which the EPS will remain same, right? Now if you see, for doing the cash payout, the company either needs to borrow or it will have to take into account the opportunity cost of that amount, right? Because whatever that company is paying off, it has to be adjusted for the return we would have got otherwise, and that return should be post tax, right? So let the cash payout be x. For the second scenario, let the cash payout be x, right? And it has to be in such a way that the EPS computed because of this cash payment is equal to the EPS pre-merger, which is 4 rupees, right? So 4 is equal to, now again, what are the current level of earnings? 80 lakhs plus 15.75 lakhs, which is the target company's earnings, minus on X, we will end up giving up how much percentage? 15 percentage is the return. This one, right? Or let's say the borrowing cost, by whatever name you want to call, right? And on that, we will be able to save 30% because of the tax, right? So 1 minus 30%. This whole divided by 20 lakhs, right? 20 lakhs are the number of shares as of now. That's why. Okay, students. Now, if we solve for this, then it becomes 95.75 lakhs minus 0.105x is equal to 80 lakhs. So x becomes 150 lakhs. So if we are paying 150 lakhs worth of cash to acquire the target company, we will maintain the same level of EPS. See, because ultimately we are getting 15.75 lakhs as well, right? So we are getting 15.75 lakhs as well, and hence the overall amount that can be paid is 150 lakhs. Because effectively the impact of 150 lakhs is not coming straight away. Only 15% of the impact is coming on the EPS, right? Which is effectively the borrowing part. Let's move to question number 15, students. XYZ Limited wants to purchase ABC Limited by exchanging zero point 0.7 of its shares for each share of ABC Limited. Relevant financial data are as follows: equity shares outstanding, EPS is given, and market price is also given. I think you might have to mention here. Please mention this is for XYZ and this is for ABC. Illustrate the impact of merger on EPS of both the companies, which is fine because they have already given us the swap ratio. So, basis that swap ratio, we have to tell them the impact of EPS on both the companies. The management of ABC Limited has quoted a share exchange ratio of 1 is to 1 for the merger. Assuming that the PE ratio of XYZ Limited will remain unchanged after the merger, what will be the gain from the merger for ABC Limited? Right now, basis the revised 1 is to 1, we have to do the computations. What will be the gains losses to the shareholders of XYZ Limited? Determine the maximum exchange ratio acceptable to the shareholders of XYZ Limited. Simple. I think all these parts in the previous questions we have done in some way or the other. It's just an integration of all those workings, right? So let's go step by step, students. Sorry, this was ABC. So first of all, impact of merger. We have two companies, XYZ Limited and ABC Limited. So the number of shares are 10 lakhs and 4 lakhs. EPS 40 and 28. That is also given in terms of the clean info, right? Then earnings is given as, rather we can compute as 40 into 10 lakhs. This is 28 into 4 lakhs. This one into 4 lakh and 40 into 10 lakhs, right? So EPS multiplied by the equity shares will give us the overall earnings, which is 400 lakhs here and 112 lakhs, right? So this is going to be 4 crore and 1.12 crore. Very good. for the reply. Thank you for the reply, Ojajini. Right, so these are the earnings. Then EPS post merger, or first of all, let's say basis the swap ratio, can we calculate the number of shares? The answer is yes. Issue of shares will be 0.70 into 4 lakhs are the existing number of shares, right? So this will become 2 lakh 80,000. The EPS post merger will become 400 plus 112 divided by 10 lakhs plus 2 lakh 80,000, right? So we have merged the earnings, and in the denominator we have taken the existing number of shares, plus we have taken the number of shares to be issued on account of this swap, which is 2 lakh 80,000. So this is going to be 10 lakhs plus 2 lakh 80,000. So the EPS post merger will become 40. Correct. So the overall EPS post merger of the combined entity becomes how much? 40. Yes. Then let's come to the XYZ and ABC EPS post merger. For XYZ, in which phase one share was pre-merger and one share was post-merger, so it will remain 40. For ABC Limited, what it will be? Come on, students, tell me. So 40, what is the post-merger EPS equivalent for ABC Limited shareholders? Come on, students, tell me. This is very simple and easy. Will it be 40 or will it be something else? So post-merger EPS for ABC Limited's shares, what will it be, students? Come on, tell me. What will it be? It will be 40 or what? It will not be 40, right? Yes, it will not be 40. It will be 40 multiplied with the swap ratio. 28. Yes. Correct. So 40 multiplied with the swap ratio will give us the EPS post merger for ABC as a comparative. Now then EPS before merger is here 40, right? And what was it? 28. So net net there is no impact. Nil and nil, right? So effectively there is no impact because of this. Clear, students? So this is done. Then the next one, the management of ABC Limited has quoted a share exchange ratio of 1 is to 1 for the merger, assuming that the PE ratio of XYZ Limited will remain unchanged after the merger. What will be the gain from merger for ABC Limited? Now they are asking us to compute basis the revised exchange rate. Sorry, exchange ratio. 1 is to 1. EPS will become 400 plus 112 divided by 10 lakhs plus 4 lakhs is equal to 36.57 per share. Simply we have taken 1 is to 1, right? 4 lakhs were earlier number of shares before issue for ABC Limited, and 4 lakhs are the post ones, right? So the PE ratio will become 6.25 per share. Sorry, not per share, 6.25 times. My bad. The P ratio becomes 6.25. MPS post merger will become 6.25, which is the P ratio pre merger, right? Because it is said that P ratio will remain same. 6.25 is the, so this 6.25 has come from 250 divided by 40. In case some of you are wondering, because that's the missing link. Yeah. So in case there is a doubt, this 6.25 we have computed how? 250 divided by 40. Okay. This is the P ratio. So MPS post merger is 6.25 multiplied by 36.57 per share. So the MPS becomes 228.56. Clear? And hence the previous price was how much for ABC company? The price was 160, right? Against this 160, now the revised price for the shares for them becomes 228.56. So the gain to shareholders of ABC Limited becomes 228.56 minus 160. And why we have not multiplied this with the exchange ratio? Because already it is 1 is to 1. So even if you multiply, the same answer will come. Now clear? So hence the gain or loss to the shareholders of ABC Limited is this much. Now what is the third part saying? Third part is saying what will be the gain loss to the shareholders of XYZ Limited. Now they are asking us to calculate the gain or loss to the XYZ shareholders of XYZ Limited. Okay. So the market price of merged entity has how much, has come how much? Basis 1 is to 1. market price of merged entity has come out to be 228.56, right? What was the pre-merger amount per share? Pre-merger amount market price per share was 250. Market price of XYZ entity before merger, it becomes negative 250, right? And hence 21.44 is the loss from merger. See, if you really see, before merger the value was higher per share, but after merger the value became dropped. Why? Because they have done a wrong deal, right? They have done a deal in which they are ended up issuing higher number of shares for getting a value of lower, right? For getting a lower value, they have ended up issuing a higher number of shares. Then the next one, determine the maximum exchange ratio acceptable to the shareholders of XYZ Limited. Now, the maximum exchange ratio, again, using the same logic, we'll have to calculate. Let's see, first of all, what is the total earnings. We'll have to calculate the combined value minus their own value and hence the value of the maximum amount that they can give it, right? So the total earnings was 400 plus 112, which is 512 lakhs, right? The PE ratio, which we computed above, is 6.25 times, and hence the market value becomes 512 into 6.25, which is actually 3200 lakhs minus value of XYZ Limited before merger. So this will be 10 lakhs multiplied by 250, right? This was the original value before merger. So XYZ Limited was holding 10 lakh shares at the rate of 250 each, right? So this is the value before merger and that is the value post merger. The difference between both of them will give us that what is the extra amount, what is the maximum amount XYZ can bear it on account of ABC. Sorry, this is ABC or what? Yeah, ABC. Yeah, ABC Limited. Yes. Yeah. So this is how much? 2,500 lakhs. 700 lakhs. Yes. Very good, Ojajani. You are responding. You are also simultaneously solving. Very good. Value of merged entity is this much, right? So if the value of the, so basically value of the target company, I can say the maximum value of the target company. Let me reword it. And the market price is 250, right? So the number of shares maximum possible is sorry, 2.8 lakhs. So the maximum exchange ratio basis this formula is 2.80 is to 4, which is effectively zero point 0.7 is to 1, with which we started the question actually, right? This is the same exchange ratio from which we started the question. I hope this is clear, students. Please do let me know. Clear? So let's move ahead to question number 16th now. Longitude Limited is in the process of acquiring Latitude Limited on a share exchange basis. Following relevant data are available. Profit after tax, longitude and latitude it is given. Number of shares 15 lakh and 16 lakh. Earnings per share 8 and 5. Price earnings ratio 15 and 10. You are required to determine pre-merger market value per share. And the maximum exchange ratio Longitude Limited can offer without dilution of EPS and MVS, which is market value per share. Calculate ratios up to 4 decimal points and amounts and numbers of shares up to 2 decimal points. So that is okay. So they are asking us to calculate the pre-merger market value per share, which is very easy, right? We have been given PAT, we have been given the EPS, we have been given the price earnings multiple basis that we'll be able to calculate the market price per share. And the maximum exchange ratio that we can compute is basis the EPS and market value per share to be remaining constant. So let's see that. So solution. So let's talk about longitude and latitude. Okay. PAT is how much? 120 and 80. This is the PAT. Number of shares is given as 15 lakh and 16 lakh. This is all. Let me put this is in lakhs, figures in lakhs. This is 15 and this is 16. Then EPS is actually 8, right? This is also given, but this can also be computed. So 80 by 16 is equal to 5. Then PE ratio. This is always the main input to calculate the valuation. Is 15 here and is 10 here. So the MPS, market price per share, becomes 8 into 15, and here it becomes 10 into 5. This is 50 and this is 120. Very good, Urajani. Yes, you're right. So we have calculated the pre-merger market prices per share. Then let's calculate the exchange ratio so that the EPS is same in the first part and market price is also same in the second part. Okay. So for the second, let me put at the calculation of exchange ratio. EPS to be same. Right? For the first part, let's take the case where EPS needs to be the same. So let the number of shares be X. So what is the profits? 120 and 80, right? So 120 plus 80 divided by the number of shares currently that are there is 15 plus X. And the EPS pre-merger was how much? 8 rupees, right? This one. 15 are the number of shares plus X we have assumed to be issued, right? So if we solve for this, X becomes 10 lakhs, right? X becomes 10 lakhs. So 10 lakhs shares for 16 lakhs shares issued. See, for the other one, the latitude one, 16 lakhs are the number of shares, right? So again, 16 lakh, 10 lakhs will be issued. So this becomes the exchange ratio. 10 is to 16, that is 0.625 is to 1. 0.625 is to 1 becomes the exchange ratio, students. Right? Right? Even this was possible using the EPS also, right? EPS was 5 divided by 8, correct? So whatever has been computed basis the EPS, the same is computed basis this formula of letting the shares to be X. Okay. Even this also would have been, see, 5 is the EPS for latitude and 8 is for longitude, right? So 5 divided by 8, again this would have been 6.25 is to 1. Now the B part, market price to be the same. Let the new equity share to be issued be X again, right? So effectively it will be 120 into 15. Let's take the overall market value, right? Market cap plus 50 into 16 divided by 15 plus X is equal to 120. Right? So 120 is the pre-merger market price. 15 is the number of shares pre-merger, X is what we have assumed, and in the numerator we have the total market cap after the merger, right? So here the X becomes 6.67 lakh shares. So the ratio is 6.67 is to 16, or 0.4169 is to 1. This is the ratio. Okay, and the same thing again can be re-verified from the exchange ratio using MPS as the base, wherein we would have used 50 divided by 120, right? 50 is the MPS for latitude and 120 is the MPS for longitude, which would have been 0.41667 is to 1. It's almost similar because of the rounding off. Very good, Ojajini. Thanks for the answers. Now, students, any questions, any doubts till now, please do let me know. So this marks the completion of question number 16. Okay, I hope this was easy and yes. So let's move ahead with the next question. Question number 17, students. Yes, Ujajini, you're right. We can use any manner, right? I'm just telling you both the ways it is answer is coming out to be the same. Now, question number 17. Simple Limited and Dimple Limited are planning to merge. The total value of the companies are dependent on the fluctuating business conditions. The following information is given for the total value, debt plus equity structure of each of the two companies. They have given us the probability, Simple and Dimple. They have given us the value, right? The current debt of Dimple Limited is 65 lakhs and Simple Limited is 460 lakhs. Calculated the expected value of debt and equity separately for the merged entity. Now, this is again a simple yet different question, right? So, let's compute the numbers, right? So, first of all, we have to calculate the overall value, right? So, the Simple Limited. Okay, let's start with the solution, students. So for Simple Limited, can we first of all calculate the breakdown between debt and equity? This will be in rupees lakhs. We are talking about high growth. We are talking about medium then, and then finally slow. The total value is how much? 820, 550, and 410. 820, 550, and 410. Now, what is the debt value out of it? Debt value will remain same, right? Whatever the fluctuation will come, that will come for equity value, right? So 460 is the debt value. 460 is the debt value. But here, if already 410 is the overall business value, debt value cannot be 460. It will become 410 only, right? Because the creditors or the the people from whom we have taken a debt will be paid only to the extent of 410. So it will become nil. It will become 90 here. It will become 360 here, right? So why we have taken here 410? Because minus 50 in equity is not possible, right? Because we cannot demand more money, right? Because of limited liability clause, and hence the value of debt stands out to be rupees 410. Clear? See, it is simple to understand, right? We cannot put it here minus 460 and arrive at a minus 50 number below, right? Simple. Now let's evaluate for Dimple Limited also similarly. The breakup between debt and equity. High, medium, and slow, right? So the total for Dimple Limited is 1050,825,590. Clear? And out of this, the debt, again, which is a fixed value, is 65 lakhs. And hence the equity is the difference between these two. 985, 825 minus 65, 740, sorry, 760, and 590 minus 65. So this is 525. These are the equity values. Yes, Ojajini, your answers are correct. Now, can we calculate the expected value of debt and equity? The answer is yes. We have to just multiply with the probabilities. Calculation of expected value of debt and equity. So let's talk about again Simple Limited. So here we take high growth, medium growth, and slow growth. If we talk about debt, this becomes same, right? 460, 460. But please remember for slow it was 410. So 20% for 460 plus 60% for 460 plus another 20% for 410, right? This is for debt. So hence total debt is equal to 450, the total debt number. For equity, it becomes 0.20 into 360 plus 0.60 into 90 plus 0.20 into 0, right? Because here the equity was 0. So the total equity is 126, and hence the total expected value is equal to 450 plus 126, which is equal to 576. This is for simple limited, right? Similarly, for dimple limited, high growth, medium growth, and slow growth, right? So the debt, again, 20% chances for 65, 60% chances for 65, and 20% chances for 65. So the total expected debt is equal to 65 here. And equity is 0.20 into 985, 0.60 into 760, and 0.20 into 525 students. So the total expected equity equals to 758 students. Clear, students? And hence the total expected value, which is 65 plus 758, 763, 823. Yeah. Equity plus debt becomes 823 students. So this is for Dimple Limited and this is for Simple Limited, 576 and 823. These are the total values that becomes. Now let's read the question. The question says that the calculate the expected value of debt and equity separately for the merged entity. Now we have to compute for the merged entity, which is just a horizontal summation. Value of merged entity, right? So we will stay with equity, Simple Limited 126, Dimple Limited 758, which is in totality 884, and debt Simple Limited 450 and Dimple Limited 65 515. Easy and simple, students. There was nothing much in this question. It was just a simple plain calculation. The only catch was that the overall numbers cannot be less than the debt numbers, right? Or debt number cannot be higher than the overall numbers. That was the first part of the question, wherein we said that we will have to restrict it to the amount that was mentioned as debt. Now, any other question, students? Any other doubt till now? Please do let me know. We have covered till question number 17 in the today's session. I'm not picking up further questions that will take because the next question itself is a kind of big question. So now, if you see, students, we are left with three questions: 18th, 19th, and 20th, as far as the mergers and acquisitions is concerned. And apart from that, there is some theoretical aspects in mergers and acquisitions as well as in the startup finance that we will be taking up in the next session, which is scheduled on 30th. So till now, students, is there any other thing that you want me to discuss on mergers and acquisitions or on the or anything else? Please do let me know. We will kind of discuss that. Today we covered good amount of questions, right? Because the idea was to practice the concepts that we discussed. See, there are two, three, catching points in the entire mergers and acquisitions. One is that whenever we are there to analyze the pre and post scenario, right? Always remember that post merger EPS or post merger market price is never going to be the same for what pre-merger was, right? Because of the differences in the exchange ratio. The exchange ratios are quite different. That's why we cannot compare the pre and post numbers, at least for the target company. The acquiring company still we can do, right? This is the biggest takeaway. Then second is the maximum exchange ratio, right? From the point of view of acquiring company. So that is the overall combined value of the entity minus its own value. Whatever is the difference can be paid as the maximum amount. The minimum amount expected by the target company will be what they are currently having as their market prices, right? Or even the book value for that matter. So we have to really understand how or what inputs are given in the question, make use of those inputs, and arrive at what is required in the solution. Hence, I'm saying there is no single logic or there is no single yardstick which we can use to solve the questions because every question is going to be unique, right? Now, for example, that gearing question that we discussed today, right? So, we need to apply our knowledge, apply our understanding of the gearing, ungeared, geared beta. Then accordingly how the cost of equity is calculated, you would see that even the CAPM also played a role, right? And in terms of valuation, dividend discount model is also being used apart from the PE valuation. So I mean, it's a holistic thing, right? Some of the concepts you have discussed earlier in the earlier topics, some of the things we are discussing it now. So I mean, yeah, that's about it on the overall side of the mergers and acquisitions. So, in case is there any doubt, please do let me know. You can maybe unmute or speak, or even if you want to write on the chat box, I'm happy to take it up. In case there is nothing, then we can maybe call the class to an end for today's session. In the next session, as I said, we will continue with the balance parts. Okay, yeah, we can then close the session. Yeah, thank you then everyone for your patient listening, and we will see you in the next session then. And then please do revise the concepts, please do revise the questions, right? Then only it will have a better grip in terms of your understanding. Okay, thank you so much, have a nice day ahead. Thank you. Technical team session over. Yes, yes, session over.